Good afternoon. I'm Don Lam, co-founder and CEO of Vina Capital Group. I'm speaking to you from Ho Chi Minh City, where we are weathering the COVID outbreak reasonably well. Before I talk more about that, I want to tell you a little bit about who we are. For over 17 years, Vina Capital has been the leading investment managers in Vietnam. And during that time, we invest more than $5 billion across all asset classes, including stock, private equity, real estate, venture capital, and fixed income. Our flagship fund, the Vietnam Opportunity Fund, trades on the main market, the London Stock Exchange, and we share several open-ended funds. We also have partnership with other firms, including DFJ in our regional VC fund, and with Warburg Pincus from the US in Lodges, a hospitality platform developing and managing over 20 properties in Vietnam and elsewhere in Southeast Asia. And finally, we have a new venture capital investment platform called Vina Capital Venture, which we launched in 2018 together with our partner, Murray and Naver. Today, I want to share my view on the enormous opportunity to successfully invest in Vietnam. We will briefly look at where the country stood at the start of the year, how the Vietnamese government has been tackling the COVID outbreak, how it affects the economy, why Vietnam is still poised to record solid growth despite the outbreak, where and how to invest, and finally, some cautionary note. First, let's look at the Vietnam outlook pre-COVID-19. In 2019 was a really good year for Vietnam. With GDP growth above 7%, Vietnam ranked as one of the world's fastest growing economies. Foreign direct investment continued to inflow with registered FDI reaching over $38 billion, up over 7% from 2018. Meanwhile, dispersed FDI totaled over $20 billion, a rise of almost 7%. Korea was the top investor with a registered FDI of nearly $8 billion, or about 21% of the total. Inflation was manageable, while much higher than 2018, but still low compared to other years. This was mostly due to the Asian swine flu outbreak, which caused the price of pork to skyrocket. Food make up a largest part of the basket in Vietnam CPI. The Vietnam dong was very stable over the course of 2019. It actually posed a slight appreciation of 0.1% compared to other currency, which is a good sign. So when COVID-19 pandemic hit, it was early January when the world first started waking up to the novel coronavirus outbreak occurring in China. Korea was hit hard in those early days of the virus too. Vietnam didn't see the same level of infection, but that didn't stop the government from taking the outbreak seriously. Vietnam had been proactive and aggressive in taking it on, leading to being on a war footing. Over the course of the last 3 months, they have implemented a number of incremental steps. The last week of January was a Lunar New Year. The government announced that school would not reopen after everyone returned from the holiday. So essentially, they have a really long Lunar New Year holiday up until now. On February 1st, flight from China was stopped. Testing and quarantine protocol were implemented, and a public health campaign was launched. For most of February, Vietnam recorded 16 confirmed cases with no new case recorded for nearly 3 weeks. Then early March, new case arrived in Vietnam from Europe, starting a massive increase. As the situation worsened in places like Italy, Spain, and the UK, the Vietnamese government suspended the entry of Europeans in mid-March. A few days later, saw suspension of new visa and mandatory quarantine for arrival. ASEAN arrival also was suspended, and by March 25th, all international arrival was halted. This eventually led to the April 1st declaration of a pandemic and mandatory social distancing measure for the entire country. Domestic travel via train, plane, buses was severely limited, but it's important to know that this was not a lockdown as seen in other countries. Essential business still remain open. So the result is that we have a fewer cases, many recovery, and no fatality. These and other measures seem to be working. Vietnam have recorded far fewer positive cases than its main neighbor and no death. Meanwhile, other neighboring countries have a very different responses. Malaysia went into a formal lockdown weeks ago, while Thailand had only just implemented one. It also continued to allow flights from China long after others have halted them. Meanwhile, Indonesia went weeks without reporting a single case. It was since disclosed the government there had been less than transparent in announcing cases for fear of causing a panic. And Vietnam have actually responded, had earned an international recognition. This outbreak had far from over, but thus Vietnam approach, but so far, with limited resources, seem to have been very effective. This have not gone unnoticed by other countries. The World Health Organization, international media have applauded Vietnam for the way it handled the outbreak. So what's next? The government is looking at ramping up stimulus. Governments around the world are stepping up to manage the economic distress caused by COVID-19. In fact, Vietnam had now put together a comprehensive package of stimulus measures that amount to nearly 5% of GDP. And the government will continue to monitor this fluid situation and supplement stimulus if necessary. At present, social security package designed to aid Vietnamese people include direct cash payout to affected workers, household business, and the poor for the next 3 months. This aid is estimated at $2.6 billion. Interest-free loan, valued about $700 million, will be made available to businesses to continue paying employees during the disruption. There will also be a 12-month delay on the payment of social insurance. The fiscal package for the affected business totaled $3.4 billion, but may be nearly double if needed. This includes a range of tax holidays for VAT, or value-added tax, and corporate income tax, as well as personal income related to household businesses. It applies to a wide range of sectors. Finally, a credit package from the State Bank of Vietnam will be issued to the bank at the preferential lending rate. This component, which is not including the 5% GDP figure I mentioned before, amount to about $13 billion. So it should be clear that just as the government had been aggressive in handling the medical situation, it is applying a similar approach to the economic situation as well. So when will recovery and reconstruction begin? Well, it's difficult to pinpoint a date. As we know, the situation continues to evolve around the globe. However, given the current trend, we are hopeful that Vietnam will have the situation under control very soon. There's clearly been progress in flattening the curve in Vietnam. And some of the studies have suggested Vietnam's warm tropical climate and young population could be a factor in relatively low number of infections, their severity, and ultimately fatality. While these are very positive, the Vietnamese government will also consider the situation outside the country, regionally and beyond, before it is likely to begin loosening the measure it had put in place. Nobody wants to see a resurgence once it appears things are under some level of control. What are some of the vulnerability that Vietnam is facing right now? Well, shifting back to the economy, Vietnam has some vulnerability that are considering the impact of the outbreak. First, import and export are equal to about 200% of GDP. And with supply chain, logistics, and demand disrupt globally, it may take some time for things to ramp back up again. Further to that point, manufacturing is affected. 1/3 of Vietnam import coming from China, like most other countries. And those are typically assembled into finished products that are then exported. China is resuming some level of normalcy, but it remains to be seen how long it would take to reboot manufacturing there. Additionally, demand for the product Vietnam export from the US and Europe could be subdued for a while till this market reopens. Tourism has essentially come to a halt, and it remains to be seen how long that would be the case. Even if arrival bans are lifted, the world airlines have dramatically reduced their schedule. Finally, domestic consumption dampened sentiment, at least for the time being. So how's the COVID-19 impact on 2020 growth? Well, obviously, the outbreak is having a huge impact on growth. The previously mentioned manufacturing, domestic consumption, and tourism sector have been hit hard. At the start of the year, Vietnam had expected to record a GDP growth of approximately 6.5% for 2020. Our chief economists now believe that the figure will likely to be around 4%, which is a major drop from what we estimated. What about the Vietnam Dong? Well, the Vietnam Dong, the currency, has remained resilient. The stability of the currency has often been a concern. But over the past few years, the government has made stability a priority. As a result, the Vietnam Dong has fared much better than regional currency, as well as other emerging markets in the world. It is also important to note that Vietnam is in a far better place financially now than it was during the global financial crisis. At that time, the Vietnam Dong depreciated by approximately 20%, leading to many of the concerns from some international investors still have today. Back then, Vietnam FX reserves were equal to 1 month import. Now, the FX reserve total about $85 billion, or about 4 months of import, better than the World Bank recommendation. The country's current account surplus for more than 9 years running also has contributed to the stability. There's a little risk of hot money outflow that was seen during the GFC, global financial crisis. In short, it appeared that the government learned some very valuable lesson a decade ago, enabling Vietnam to effectively deal with COVID-19 pandemic today. So Vietnam is set to prosper post-outbreak. What will we do? Well, we cannot be sure when the period defined as post-outbreak will take effect. However, there are a number of reasons why we believe Vietnam will continue to prosper. Foreign direct investment will continue to flow into the country. The US-China trade war is expected to resume and perhaps even intensify. Globalization will continue, but likely to start a new chapter, one where the focus more on the region rather than global. Supply chain will become more diversified as companies have realized there's different risk, if they hasn't already, of putting all their manufacturing and raw material egg in one basket. Investors will also have another look at frontier and emerging markets like Vietnam. There will be an enormous amount of money printed in developed country and economy, and with the US predicting far lower stock market return for the foreseeable future, the return of market in Vietnam will be attractive once again. Even prior to the pandemic, Vietnam had become the location of choice for manufacturers such as Samsung, LG, Intel, and others in the electronic industry. The US-China trade war and the resulting tariff and uncertainty demonstrated the need for a more diversified manufacturing base. We now expect that to accelerate, Foxconn and other suppliers have already signaled move to shift some production to Vietnam from China. And more importantly, we expect this to be the catalyst to help build out the supply chains in Vietnam. It had long been an issue that so many components for goods needed to be imported to be assembled into a finished product. We now expect that multinational companies will address that via technology and operating skill transfer. So the market inflow. As I mentioned before, the US and European stock market are unlikely to rebound anytime soon. Our chief economists believe that the US has now entered a Japanification period of little or low growth in the economy and stock market. QE and money printing will total up to $7 trillion over the next 2 years. And with US pension fund under pressure, we expect the market, like Vietnam, to become increasingly attractive to deliver the return of greater than 7% per annum over the next decade. So, promising sector. Where should all this money be invested in? What are the promising sectors we're looking at? We have always preferred those sectors that are benefiting in Vietnam's domestic consumption success story. This is driven by several factors, including the urbanization, the young demographic, better job and higher income, and a growing middle class. The consumer discretionary sector have traditionally seen the highest growth. People with more money in their wallet will be spending it on dining out, consumer electronic, jewelry, just to name a few. Although there will be a short-term hit from the outbreak, we continue to expect this sector to resume strong growth. Healthcare is another sector benefiting from the growing middle class. Vietnam public healthcare system is expansive but overburdened. Private healthcare is expanding and enabling some people who previously would have to travel to Bangkok or Singapore for medical care to receive it at home today. Energy is also another promising investment in the sector. It's a top government priority. Demand of energy is outstripping supply, requiring Vietnam to import some of the electricity it used. More manufacturing coming to the country will only increase demand. LNG and renewable energy source are the future for Vietnam, and investment opportunity abound. Domestic manufacturing of goods and material used for construction, infrastructure, and property development is also an interesting sector. The government expects to accelerate infrastructure development as a way to boost the economy, and locally sourced material will be the key. On a related note, we intended not to invest in companies that manufacture mainly for export. The uncertainty are too great. Finally, technology or tech is very interesting. Vietnam has been seeing a tech boom over the past few years, with startups working in a wide range of areas, including fintech, AI, real estate technology, and logistics. It was an enormous promise of this scene that led us to launch our Vina Capital Venture vehicle back in 2018. Now, tourism will definitely make a comeback in 2021. As I mentioned earlier, tourism was growing rapidly pre-outbreak. That is now on hold. However, we expect that tourism will pick up once again in 2021, and Vietnam could benefit enormously as it's seen as a safe haven from the outbreak and offer great value for money, in addition to beautiful scenery and a rich culture. Of course, the timing of this depends on the global economic condition, transportation option, and the medical situation. But now could be a good time to invest in this sector as a year to reboot. Now, let's look at investing in Vietnam. This is a savvy audience, so you probably know the various ways to invest in Vietnam. I'll just highlight a few. How do you invest? The key factor to determine the method of investment determining the objective and the role. Do you want to be active and operate in Vietnam, or you would rather participate more passively? Foreign direct investment, FDI, is obviously the most active route. FII, which is foreign indirect investment via public or private equity, can be active or passive, depends on the size of the stake and the desire to involve in an investee company. Fund, like those offered by a firm like ours, and a proxy for Vietnam growth, we have experienced investment team who do the research and diligence, understand the language and the cultural nuisance, and manage on behalf of investor. Funds, IMA, and co-investment allow investors to mitigate some of this risk. Meanwhile, ETF are passively entirely. Investment constrained during the outbreak. While Vietnam stock market have corrected significantly during Q1, just like elsewhere, as March 31st, Vietnam index fell over 30%. Listed equity valuation have fallen 30 to 40%, and many stocks that once trade on a high PE are now much more attractive. The market currently trading at a trailing PE of about 10 times, the cheapest in 8 years and the lowest in the region. There are definitely some interesting buy out there. Key considerations include blue chip stock that are reasonably liquid, stock with foreign room, and those that have a history of foreign inflow. Example, they have been interesting before. Unless one has a huge appetite for risk, it's probably not the time to invest in little known or lightly traded stock. Other considering including stock in the sector that I mentioned earlier, those that will play a role in the continued development of supply chains in Vietnam. And those have delay element, such as producing a good that will be still necessary in the future versus a lost forever element, where product or services provided is gone, such as flight. Other investment considering during the recovery and beyond, once the recovery takes hold, there will be a return to fundamental. Company with strong balance sheet and market share will resume growth. This will likely drawn out period, and listed equity will continue to be volatile. This may bring a renewed focus on private equity investment and fixed income product. With respect to PE, there are going to be good promising companies that need investment to recover and resume their path to growth. The stock market won't be an option. Finally, businesses that have a weaker balance sheet but have a lower ongoing capital requirement and own real asset, such as tourism and property development, may also be worthwhile to consider. Some cautionary note: investing in Vietnam comes with some risk, just as it does in any frontier and emerging market. How can an investor mitigate those risks and prepare for the best possible outcome? So how to successfully invest in Vietnam? As an investor in Vietnam for over 20 years, I have learned a lot, both from my personal experience as well as from observing the experience of others in the market. My top line advice to foreign investors considering the market for the first time is as follows. First, you need to take a long-term view. A lot of so-called low-hanging fruit have been plucked, and the day of fast money are over. Patience is important. When operating in Vietnam, whether in terms of generating a return on investment or in dealing with bureaucracy. 2, conduct thorough due diligence. Vietnamese business can have some unique way of operating, so it's critical to get a look under the hood at the financial statement, company ownership, land use right, customer relationship, and so on. Trust is verified. It's a good mantra to live by, to quote Ronald Reagan. 3, understand the market. Vietnam is not the same as Thailand, Indonesia, or Malaysia. One of the biggest mistakes foreign investors make is assuming that all of the Southeast Asia market is the same. It's not. Each country is on its own development trajectory with its own way of working. Another mistake is assuming what worked in the home market will work in Vietnam. Successful businesses tend to be those who know the market and all about and to tailor product and service accordingly. Finally, have a trusted local partner, someone on the ground with experience, network, and knowledge of how things work, as well as the language and the culture is essential. Vietnam is open to foreigners, perhaps more than any other neighbor, but there is no substitute for having a Vietnamese partner. Conclusion. Just to wrap up my presentation, in closing, Vietnam is and will continue to be a fantastic place for investment. Although the global economy will still be an unknown amount of time to take hold, Vietnam is well positioned to rebound. Even with revised GDP growth forecasts, Vietnam is still poised to be one of the fastest growing economies in the region and the world. The opportunities here are virtually endless. But to be successful requires patience and work to know how to capitalize on them and deal with the challenges. Thank you for your attention. I'm always available to answer any question you may have via email and to discuss potential opportunity. Thank you very much.